Welcome to Business Benefits TV. I'm Jim Edholm. I'm your host. I'm the owner of BBI Benefits, Business Benefits Insurance Brokerage. And what we do is work with companies like yours, from 20 to 200 lives, trying to help you find ways to use your benefit dollars more cost effectively. We've talked in the last couple of episodes about the health savings account, the health reimbursement arrangement, so, things that smart companies are using. And we have a report over here, which I'm going to refer to in a minute, that you can order at no charge, that talks about those three things in a little bit more detail. What I want to do is talk about the third one today, and that's basically self-funding. This is probably the least commonly used, particularly in the size range of our client base, the least commonly used form of saving healthcare dollars. And yet, it really ought to be, arguably, one of the more popular ways of doing it. Self-funding basically says that you're going to share risk with the insurance company. Instead of the insurance company carrying all the risk except for whatever little deductible the employee pays, and then they carry all the risk and get all the reward, you're going to take a little bit of that risk. So the way it works, this is not a close-up view of a rug. This is a period of time of a year, let's say, and your employees put claims in, medical claims throughout the year. What you're going to do is you're going to say to an insurance company, I'll tell you what I'm going to do. The first thing you say is, I'm willing to stand up to the first $20,000 of any one claim. So I'll pay the first 20. I want to buy a policy that picks up everything beyond $20,000. So you would buy a policy that comes along in here like so, and would reimburse you on this claim, this claim, this claim, this claim, this claim, and this big Mamu claim that you got right there. Now you're going to pay a premium for that, and that's called a specific stop loss. We're just going to abbreviate that stop. So that's the first premium you're going to pay. The second thing you want to do is you don't want to have all these little claims that are less than $20,000. I mean, if we get a bird flu epidemic and everybody goes to the hospital to the tune of $1,000 or $2,000, you could be blown out of the water that way too. So you're going to purchase another policy that says, I don't want the smaller than $20,000 claims to add up to more than some amount, whatever, and that's actuarially determined. And that's called an aggregate stop-loss policy. That's the second thing you're going to pay. The third thing you're going to pay, and of course because this thing is very unlikely to be hit, because the chances of a whole lot of people using the healthcare system more than they normally do is pretty small. That's a very inexpensive policy, very small. This is large, because the fact is it's very easy for someone to have $1 million claim. So that cost is large, but nowhere near the cost of your current health plan. The next thing you're going to have to do, you're going to have to get someone to administer those claims. If you're big enough, Blue Cross, Harvard, Tufts, they'll allow you to self-fund and they'll be your administrator. But for most people, they aren't big enough to make that happen. So you go to an independent third party, a TPA, third party administrator, and they work with the claims and make sure that it's medically necessary, that the doctors aren't scamming the system, that the providers aren't overcharging, double billing, etc., etc. So they do all that stuff. You're going to pay them, and that's going to be a small amount of money. That's going to be about $40, $45 per employee per month. So it's not really a high price. And then, of course, the last is you're going to have claims. All those claims that are less than $20,000, you're going to have to pay. Now, the way insurance works, the fact of the matter is that Blue Cross, or whoever you're using right now, does this same thing. They figure out what your claims are going to be, and they what they call pooling charges, which is the same as this. They put them into the price of the policy. They put the administrative costs into the price of the policy. They do the same exact thing. The difference is what they do when they look at your claims and they expect them to be $100. What they really do is they say, okay, the pooling point, the maximum loss, isn't going to be $100. That's what's expected. It's going to be $120. They got to have some room, because some companies will be less than the pooling point, others will be more than the pooling point, and they have to absorb those costs. So they average it out, put in a risk buffer. Well, you're going to pay that in premium even if your people are healthy. That is one of the main reasons why you want to look at self-funding. The others are, you can custom make your own plan. You can have it be whatever you want it to be. You don't have to pay premium taxes on the entire premium like you do with your current plan. You only pay premium taxes on these two much smaller things. There's a lot of real serious potential savings for you, all the way down to 5 lives. We're going to talk about medically underwritten self-funding in our next episode. But there's a real opportunity for you. And if you want to know a little bit more about it, fill out this form over here. Just click on that dial. Give us your name. We'll send you the free report telling you all about the 3 strategies: health savings account, health reimbursement arrangements, and self-funding, and the way that they can be used to help you. Thanks very much for watching today, and I look forward to seeing you on our next episode. Bye.